Do you know that the tax system is set up so you pay less tax from investing compared to when you earn a paycheck or your salary? If you're not sure how that works, this video is for you. In this video, we'll break down what capital gains are, how they work so that you can take advantage of them in your wealth building journey. Capital gains occur when you sell or liquidate an asset that's gone up in value. Unlike your salary or your paycheck though, you don't have to pay tax on all of that gain. By the way, this builds on the case study we looked at in the video breaking down the basics of income taxes in Canada. You can watch that here. We all pay it, but do you know how taxes work? Do you know how much tax you pay in Canada? His total income, or watch it at the end of this video and you can check the links for that down in the description below. I'll do my best to make this digestible even if you haven't seen that one or if you've never ever invested before. Check the timestamps if you want to look at specific ideas that answer the following questions. Question number 1, what exactly is a capital gain? Question number 2, what is the capital gain inclusion rate, or how much of my gain do I actually pay tax on, and what has it been historically? Number 3, how are capital gains actually calculated? For that to be answered, we need to go to point number 4. What is the adjusted cost base? To answer all of those, we'll go through 3 examples on how capital gains apply with stocks and real estate. Our third example will dive deep into what happens when your assets lose value over time or when you lose money from a sale. This is because you can actually use that as a strategy to take advantage of what's known as tax loss harvesting. My name is Hervin Pesa. If we haven't met before, welcome. I'm a financial planner, but just like you, I'm on a journey to building wealth and financial independence. My mission is simple. It's to help you build your wealth so that you can live a life full of meaning and one that's full of joy. So I share weekly money lessons going deep into topics we all wish we learned in school. So if you're ready to take control of your finances and you'd like to join me in this journey, consider subscribing and be sure to hit the bell so you never miss any of the lessons. Bing, 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 bing. Okay? What is a capital gain? Capital gains occur when you sell or liquidate an asset. It is subject to a 50% inclusion rate currently. This means when you earn an income from work, you have to report all of that or it's included 100%. When you earn a capital gain, you will only pay tax on half of it. We currently have a 50% inclusion rate in 2021. Continuing with Joaquin from our last video, who was already at a 30% marginal tax rate, that means any extra income will be taxed at 36%. If he earned an additional 10 grand on overtime, he would pay 36% on this, which is $3,600. His net take-home pay then after the tax is $6,400. However, if he earned that in capital gains, only 50% of it would be included to his total income. So he would pay 36% on $5,000, which is $1,800. His net take-home is $8,200. However, this hasn't always been the case. Between 1988 to 1989, you would have had to include 2/3 of your capital gains, or 66.67% repeating. In 1990 to 1999, you had to include 75% of all your capital gains in your taxable income. There are a lot of fortune tellers, experts, that predict higher capital gains inclusion in the future because of the ballooning government deficit. I believe that to be a possibility for sure. But I just want to remind everyone, the biggest owners of real estate and assets that have gone up and have massive unrealized tax liabilities also have the biggest powers to lobby. We have hobbyists like me, they have lobbyists in office. So how are capital gains calculated? To calculate just how much profit you made, you would have to take your net proceeds of the sale and subtract that with your adjusted cost base. So let's first unpack what net proceeds mean. Net proceeds are calculated by taking your costs to sell the asset off of the sale price. Let's look at an example. Let's say Ellen is from Edmonton who has decided to sell one of her rental properties for $500,000. Not all of that would go to her. If she paid the average real estate commission in Alberta, which is 7% on the first 100 grand and 3% on any amount after, she would have to pay $19,000 in commissions. She'd also have to consider if she had a prepayment penalty on the mortgage. If she broke the mortgage early, in this case, let's say that she has a $2,000 penalty, that would also be included too. Lastly, any legal expenses paid to get rid of the property, in this case, let's say $1,000, would also be added to the cost of liquidating the property. With that said, her net proceeds would be $478,000. So how do we know how much she actually gained or how much profit she actually got from this transaction? We need to subtract the adjusted cost base from the proceeds. The adjusted cost base is the total cost to acquire the capital asset. Let's say she purchased the home 5 years ago for $250,000, but immediately spent $70,000 to renovate and update the unit to meet market demands, along with the $2,000 legal fee she paid to finalize the purchase. In this case, her initial cost would have been $252,000, but the $70,000 improvement would have been capitalized. So her adjusted cost base would be $322,000. Please note that the key word here is improvement. Repairs are expensed every year, but improvements to your real estate holding would be added to the ACB or the adjusted cost base. In this case, her total capital gain would be $156,000. Multiply that by 50%, which is the inclusion rate, her taxable capital gain will only be $78,000. So how much tax did she actually save? To drive the point home, just imagine this. If she made $156,000 but only paid on $78,000 of taxes, let's pretend that this is her only source of income. That's very unlikely, but this makes it easier for me. Using the calculators linked below, she would pay $17,086 on $78,000, while if she had to pay on the whole amount, her total tax bill would be $44,693. That's a tax savings of $27,607. That's a lot of money. But that's not the only benefit of capital ownership. In Ellen's case, the appreciation of the asset was tax deferred until liquidation. Over 5 years, it went up on average by $31,200. But there was no tax due during that time of appreciation. Imagine if this was done over a 30, 40, or a 50-year time frame of uninterrupted compounding growth. Before I move on, I used a personally owned rental property as an example on purpose. Because if you sold your primary residence, it would most likely be tax-free. Because your principal residence is exempt. There's a specific principal residence exemption in the tax code. The reason why I say generally though is you may own more than one property. Let's say you have multiple vacation homes in Canada. You can only declare one primary residence every given year. Your CPA should be able to advise you on which one to designate as your exempted property at the time of liquidation. There are many Calgarians, for example, who live in Calgary during the work week but have homes in Cochrane or Banff for the weekends. Be careful when designating your primary residence exemption. Always consult a CPA, not a wannabe YouTuber like me. This is a good time to say now that this whole video and everything that I produce is for education and entertainment purposes only. My intention is not to give you any advice online, it's to equip you with the right ideas and questions. So just show me how entertained you are. Show me some love. Click that button, yo. Like. Okay, let's move on. So how does this apply to stocks? I just want to make sure that you understand that this portion only applies to investments in non-registered investment accounts like your brokerage account or a margin account. Look at the RRSP and TFSA video here to understand how that would work inside these accounts. The concept though is very similar to the real estate example. You just need to understand your ACB or your adjusted cost base to understand your all-in costs. So if you pay commissions, you would add that to your cost base. If you paid commissions to sell it, you would subtract that from your sales proceed. The only difference in this case is you may have multiple purchase prices. If you buy shares at different times, or if you are regularly buying into funds every month because you want to take advantage of dollar cost averaging, this happens to adjust your cost base. Let's work with an example. Let's say Joaquin wanted to invest in shares of Hervco funds. He decided to invest $1,000 every month starting on the 1st of January this year. On January 1st, the shares of HCF was trading at 43.50 cents. After paying $10 in commission, he would be able to buy 22.75 units, assuming of course that he can pick up fractional shares. On February 1st, he does it again, and HCF was trading lower this time at $39.50. After paying $10 in commissions, he would get 25.06 units. On March 1st, he does it again one more time, and HCF is trading at $45 at this point. He pays a $10 commission, and he would end up getting 22 additional shares. But here comes the good news. On March 30th, after an earnings call, HCF is trading at 70 bucks. So he decides to sell 30 shares. His proceeds would be $2,100, but he pays $10 in commissions on this, so his net proceeds are 2,090 bucks. To determine his gain, we need to find out what the average cost base was for all the 30 shares. For our case, it's simple. He spent $3,000 including commissions to acquire a total of 69.81 shares. His average cost per share then, or his ACB, is 42.97 cents. So the total cost base for this liquidation is $1,289.10. His capital gain would then be the $2,090 minus the $1,289.10, which is $800.90. You multiply that by 50%, we would end up having to report $400.45 of additional income. So we've only talked about gains and your value going up. But what happens if you're not so lucky? What happens when your investments lose value? Let's say a portion of Joaquin's investment portfolio was in oil and gas, and his specific position has an unrealized loss of $300. We would simply multiply this with the same inclusion rate to come up with what is known as the allowable capital loss. He would have an allowable capital loss of $150 if he liquidates this position. You use that allowable capital loss to offset any taxable capital gain. If Joaquin sells the shares in HCF and his ONG shares simultaneously, he would have a total taxable capital gain of $249.65. Please note that allowable capital losses can only be used to reduce taxable capital gains. Unless, of course, it's a terminal tax return, it can't be used to reduce any other types of income. This is also why there's usually a sell-off in December. Savvy investors are harvesting losses so that they can liquidate their positions that are in profit simultaneously with losing positions. In most cases, the intention is to actually rebuy the losers in a few months. Just make sure you don't end up triggering what is known as the superficial loss rule. The CRA has provisions limiting somebody from selling and buying the same share almost simultaneously. We'll talk about superficial losses in a different video. We needed to talk about deemed dispositions because this becomes a pitfall for a lot of plans. See, whether you give up ownership of the capital or the asset, you might actually be deemed to have disposed of it. Deemed means as if you sold it, okay? This means that you would be treated as if you sold the units, the assets, the item, even if you didn't receive any cash consideration. This happens when you gift or you give your asset away. This happens when you pass and everything transfers to your estate. When you cease to be a Canadian resident, this could also become an issue. It's not uncommon for Canadians to move to tax havens and sever their Canadian ties. This will lead to liquidation of all assets, even if you transferred it to a relative. This is a hidden concern for most who have successfully amassed assets throughout their lives. Specifically, properties purchased decades ago. You may be sitting on a massive tax liability if you passed away when you try to transfer the assets to the next generation. This is actually one of the reasons why higher net worth or wealthier individuals come to us for insurance. They don't necessarily need it for protecting their loved ones today, but they need it to make sure the taxes don't blow up the inheritances they want to leave their children, their grandchildren, or sometimes their charitable causes. The exception to this is when you pass your assets to your spouse, that gets rolled over, but that needs to be covered in a separate video because we also need to discuss attribution rules in that case. The next thing you need to know is for this to really make sense globally, you need to understand marginal tax rates. So check out this video. Until next time, stay aware, take control. I love you all. Peace out.